Okay, welcome everyone to another free webinar brought to you by optionslam.com. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. Please read and understand the CFTC rule. And our disclaimer tells you that we are not licensed financial advisors, nor are we registered investment advisors. Therefore, we do not provide investment or financial advice, nor do we make investment recommendations. These webinars provided to you by optionslam.com are for educational purposes only, etc., etc. By attending our webinars, you hereby agree to our disclaimer. I am Marko. This is my email address, optionslam.com@gmail.com. That's easy to remember. OptionSlam, you're going thinking about OptionSlam, and it's optionslam.com. That's our website, and our email address is at probably the most popular email address, I'm guessing, for sure in the Western world, gmail.com. Optionslam.com@gmail.com. I am Marko. Please send me your emails, your questions, your suggestions, your comments, and etc. Let's see. Now, Marko's 1-2 punch, recently introduced in I believe it was the last webinar we did. Let's talk about this for just a quick minute and identify just what this is. The 1-2 punch strategy consists of two separate trades on the same stock. No worries, they're not put on at the same time, so you're not trying to manage two trades at the same time. No, it's the 1-2 punch. They are done independently of each other. The first punch we refer to as the 6-day pre-earnings release straddle, and it is opened and closed prior to ever getting into punch 2. So punch 1, 6-day pre-ER straddle. Punch 2 is our ZIMS trade, which has been our focus over several of our most recent webinars. We've talked about the ZIMS trade quite often lately. It's been a powerful performer. Actually, too good to be true, or too good, hard to believe type of results that we're seeing from the ZIMS trade. Now, I'm going to get into the rest of this PowerPoint, which goes into detail about the two strategies, the similarities, the differences, the rules of how you initiate these trades, etc. But before we do that, let's get into and see what our opportunities are for possibly entering a 1-2 punch strategy. If you are not familiar with the 6-day straddle or the ZIMS strategy, no problem. We're going to cover that in pretty good detail today. We only have an hour or so, so I can't go into every single detail, but your questions are welcome, and I will try to get to those as well. I'm going to go first here just to see what we have coming up. I'm going to go to our stock screener. Okay, this is probably the way most people navigate our website, is go first to the stock screener and see what's coming up. Unless, of course, you're just looking to learn more about any given specific stock, you can simply enter any stock symbol up here in this top right corner, and click the go button or hit enter on your keyboard, and then you will be presented with 4, 5, 6 pages in the black bar. We'll get to that here in a minute. Let's start by seeing who do we have coming up that we might want to consider applying the 1-2 punch strategy on. And I'm going to just use one of my saved screeners here, which I always use here. We've talked about it so many times. My generic screener has a minimum amount of criteria. And right now, we're in a very slow part of earnings season. So I only returned 7 results here right now based on this very small set of criteria: stocks over 20, stocks that have weekly options, and stocks that are reporting within 1 week from today. Now, I'm going to expand this quickly to 2 weeks from today, okay, and resubmit, because I might want to, in order to do the the 1-2 punch strategy, we need to be getting into the 1 punch before the earnings event, okay? Like a week before, even slightly more than a week before, depending on exactly what day of the week it falls. And oh geez, did that stocks with weekly action 2 weeks from today still only return 7? Let's see, is that right? Yeah, still only return 7. So that means there is really nothing out there next week. I'm a little bit suspicious of that. Uh, so let me, because I'm suspicious, I'm going to, you see this, it says a date range prescribed above overrides this field. So I'm just going to go out to next week alone. I'm just going to set a date range above, beginning, today's the 17th, beginning, I'm going to say I'm going to say Sunday the 22nd to Saturday the 28th. That includes the whole week. And let's see if I leave all my criteria the same here and resubmit that now with a date range of next week. Sure enough, it's returning 0. So, wow, is this a slow part of earnings season or what? This must be like the slowest week. Now, there are stocks that will be reporting earnings next week, but let's continue on here. Let me get back to the meat of the topic here. Let's go back. Let me clear this, and let's go back to our first results, and get that list of 7 stocks back on board here. Okay, here we go. So we got. I'm not familiar with this stock. I've never traded this stock. Micron, Accenture. This is Conagra Brands, Nike. Most of us recognize all of these stocks. Super Micro. I didn't recognize Hut. I've seen the name, but I've never traded that. And then, of course, Carnival. So these two strategies, the 1-2 punch, are both delta neutral strategies and require large movement of the underlying stock within the prescribed amount of time, which is between today, the day or whatever day you put the trade on, and the expiration of the contracts that you use. And I'll get into those details. Both of these stocks require large moves in order to be profitable. Lately, AI is everything. Everything is going up. Anything that is AI related has the potential to be a winner. And not that other stocks, such as Nike or Conagra or Carnival could not be candidates for this strategy. It's just that lately, the with the circumstances that are um, somewhat controlling the market right now, it's the AI related stocks that are having these outsized moves. So therefore, um, now Micron, I don't know that that's how AI affiliated that is. Accenture, same there, and but those two are possible candidates for sure. Micron is a possible candidate for the 1-2 punch strategy. I think we're too late for punch one on Micron, but we can take a look and see. I'm going to right click on the Micron and open that link in a new tab so that we can go just get a feel for what's going on with Micron, how's it behaved lately. We can see that the earnings event is tomorrow after the close. Okay, tomorrow after the close. It's got a 3.4 EVR, which is an indication that it's at the higher end of our EVR range and of our normal range for EVRs. EVRs range anywhere from 0 up to 10, 10 being the highest. Earnings volatility rating. You can learn more about that right here under the help menu. There's the EVR help pages. And here is some historical statistics about how Micron has behaved in previous earnings at previous earnings events, both coming into the earnings as well as what happens to the stock post earnings. And there are, as I mentioned earlier, there are multiple different pages. These are all in reference to Micron, the stock Micron. So you can go to any of those pages to get more specifics, but this particular page is the earnings history page, this first one here. By default, that's where we go. And you can see the stock can move quite large on an earnings event, okay? And here's some one trading day post earnings. These are the size of moves. This is the max move that it moved within that one trading day, and this is the final closing move. So the close 14, almost 15% higher than it closed the day before or actually in this case it's the same day. So this is the pre-earnings closing price, and the one day later, it closed at 109.88, which is $14.73, 15% higher one day due to the earnings event. And so that's what these statistics relate to here. Now, I'm going to jump over to the implied move weekly page. And I want to take note here of what the implied move is right now. The implied move weekly is at 12.5%. Well, how is that high or low? Is that a high implied move? The market is pricing in a move of 12. Sounds high, sounds like a lot. So what we can do is just scroll down to this table and find out, is that high or low compared to previous implied moves? Well, it's actually rather high. It's at 12.5%. And we can see as we look at previous earnings events, these previous earnings events are all less than 12.5%. To me, that is an indication that option premiums are elevated. If we're going to buy options, we're probably paying up for them as compared to previous earnings events. Now, I see a pattern here where the implied move, if we just go back here a couple of years. What do we have here? I think we got 10, 4, 8, 10. So this is 2.5 years of data that we're looking at, 2.5 years of earnings events. And 2.5 years ago, the implied moves for Micron were hovering around 6. See, there's a 6, there's a 5.75, just over 6, just over 6, almost 5.5, almost a 6. And then come March of 24, come just a few months back now, March of 24, the implied moves increased dramatically, jumped to 10%, 12%, 10%, and the current implied move right now for the earnings event that's going to take place tomorrow after the close is at 12.5%. To me, this kind of guides me away from the 1-2 punch strategy. Okay, why? Because I know that option premiums are inflated, and they're at the highest point they've ever been, at least in the last 2.5 years. So this is not. I would rather see a low number here if I'm considering the 1-2 punch strategy. But we don't have a lot of candidates to work with. And it's not that the strategy can't work when implied volatilities are very high and therefore the implied moves are rather high. It's not that it's not the end all. Okay, so we're gonna, due to lack of candidates at this particular time, because we're in the slow part of earnings season, we're gonna work with Micron regardless of that. But I did want to bring that point up. Another point I want to bring up is that we have the implied move monthly page, which isn't as relevant to our topic today, as well as the post earnings page, which is relevant when you are in a trade and then you're trying to manage the trade and decide whether to close the trade, take profits, lock in losses, prevent further losses, or do some other management strategy. And this page at optionslam.com can be very useful and beneficial to help you make those kinds of decisions by seeing how the stock behaved in the past after a big earnings surprise. Okay? After a big earnings surprise. Did the stock continue to go up? If it moved up 14% here, and then within 5 days it was up 21%, and within 2 weeks it was up 27%, this is good information. But on a down move of 7% fall, I'm just trying to give you an example of one very quick example of how this post earnings page can be used. You can say, well, on this up move, it extended the move substantially. On this up move, it didn't really expand the move, but it actually gave half of it back within 2 weeks. But then within 3 weeks, it recaptured what it had lost. On this down move, within 2 weeks, it was still holding down at about -8%. So anyway, there are patterns that you can try to observe and take into consideration when deciding how to manage a trade. So let's go now to the trading platform that I like to use the most for illustrating this option strategies and the rest of it all. But let's go and look at some previous examples here. Let's not look at Micron quite yet. Let's jump over here to PLTR, which that was a recent ZIMS example that brought and returned 2,000, believe it or not, 2,000, I believe 2,100% profit on the ZIMS trade. And let me just illustrate that by going to, I use OptionSlam's backtesting tool to bring this information into black and white and right to the table so that you can see it with your own eyes. And let's see, let me find that here a quick second. Okay, so here's the PLTR ZIMS trade. And this data is this little Excel spreadsheet. Excuse me. This little spreadsheet is produced by OptionSlam's backtesting tool, which is available to all of you who have an account at optionslam.com. And I find it very powerful. I use the OptionSlam backtesting tool pretty much daily. And so this is the ZIMS trade. You can see this information up in here in this section is what I'll call the metadata. This is the information I provided OptionSlam's backtesting tool to put on to backtest how this trade performed. I told OptionSlam's backtesting tool, the OSBTT, that I want to enter this trade at the end of the day on November 4th. All of our data is end of day data, just like Thinkorswim says. Okay, the stock price was 41.41. OSBTT knew that. I want to do a strangle. I told it I want to do a strangle, a long strangle, and I'm going to buy a put at the 31 strike. I call it the 52 strike. I'll show you how I determine what those strikes were. I'm buying those as opposed to shorting them. And OptionSlam backtesting tool does allow you to control the quantity, but only if you use the custom. I'll show you when we get to it. I'll show you where the custom feature is. You have to use the custom in order to determine, to tell it how many contracts. Otherwise, the default is 1, but you can override that by using our custom feature. And upcoming earnings date, this is just some information OSBTT throws in here to let you know the upcoming earnings date is the 4th. It doesn't determine. Now you have to go back to the website. It doesn't say after the close or before the open, but that information is available at the website, okay, at the regular part of the website. And it does throw in another little bit of information, and that is that the earnings volatility rating of this stock is 6.7. So here we go. This strangle cost $62. This was the debit to buy the strangle. And of course, day one is always 0% profit because the software assumes that you are buying it at the end of the day. So day one, trade day one, is always going to be a 0% because you bought it and then the market closes. Okay, so you bought it at the end of the day, the market closes, there's theoretically no P&L. But immediately the very next day, the ZIM strategy produced a profit of $103. In other words, the value of the strangle that you bought that for $62 is now $165, represents a $103 profit. And then this is just a little formula that the OSBTT does not throw this formula in because the formula varies, depends on the strategy. It's different for every strategy. And for this strategy, it's simply the profit divided by the risk equals the profit percentage. And then I just write that formula, E15 divided by D $15. Okay, because the risk doesn't change. D $15 always makes it refer back to this cell. And then there's that 2100, 21%. Now there's the ZIMS trade, and we went into this in great detail in a previous webinar. I just ran through it with pretty good detail, but you know, I tried to get through it quickly. Now, let's go and look at the other trade that we didn't do on PLTR, pre-earnings, the 6-day pre-ER straddle. And I just ran this back test. I believe it was this morning, but very recently, I just ran this back test. And you can see here's the earnings date. That previous back test, let me just slide this over. That way we can see them both on the screen at the same time. Okay, this is the ZIMS trade, and you see it there. And then this is the, let's make that bold, the 6-day pre-earnings straddle. So this is punch 1, this is punch 2. So you can see the difference here, a couple differences. I'm going to highlight these all back again. I'm going to come back to highlighting all these differences. I just wanted to show you. So look at the difference in the of the cost of the trade. All right, this trade cost $637. Look at when this trade was initiated, 6 days prior to the earnings date. Okay, when was this trade initiated? On the earnings date, right before the earnings came out, at the end of the day on the 4th, and then at the end of that day, the ZIMS trade is initiated, and you hold this trade through the earnings event. You put it on before the earnings event, and then you hold it through and suffer the IV crush that we're always so concerned about. But I talked about it recently, and I'll talk about it a little bit again today. It is not much of a concern for the ZIMS trade. The ZIMS trade is of very little concern about IV crush, and I'll get, hopefully I'll find time to get into that. But this trade, the 6-day pre-earnings straddle, is very sensitive to IV crush, and we do not want to experience IV crush on a long straddle initiated prior to the earnings event. Why? This is a perfect example. This happens to be a perfect example. Even though the stock went, let's look at this day by day. Even though the stock went from $41 up to $51. Is that not 25% move? Is that not a $10 move on a $40 stock? Is that not about a 25% move? Even though the stock went up 25% in one day, what was the profit on that long straddle if you would have held it? Notice this says must close the trade prior to the end of the day on the 4th. If you don't close the trade, you are subject to IV crush. And that's why I'm pointing this out, that look at what the profit was. It was $3 on a 25% move. Essentially 0% profit. Now, yes, granted, it continued to move, and it ended up bringing back a very nice profit had you held it. But the core principle of the 6-day pre-ER straddle is not to hold it through the earnings event. Note, when is the earnings event? November 4th after the close. Here's November 4th. The stock was trading for 41.41. You can see that right here as well, over here in the ZIMS trade example. And the note is must close the trade prior to the end of that day, because you do not want to be subject to implied volatility crush. So even though these trades are very similar, they're very different, and I'm just pointing out a couple of things. Now, how did this pre-earnings straddle turn out? Well, it didn't do very good. It didn't do very good at all, even if you would have closed out and held the trade, closed the trade as the rules of the 6-day pre-ER straddle demand. Okay, the rules demand that you must close this trade prior to the end of the day. before the earnings comes out, win or lose, guess what? You don't lose very much. 4%, 1%. Here's even a possible, here's a little gainer there. There's a day where you could actually picked up 2% profit on the pre-earning straddle. So did the pre-earning straddle punch one of the 1-2 punch work out for Palantir on this most recent earnings event? No, not so much. Not so much. Okay. All right. Let's look. Sure, we could save that, whatever, and then we'll close that one. Let's look at another one, and through the eyes of of our back tester. Let me see something here. Quick minute. Gary says that the visuals are not keeping up with the is the screen being shared? Huh. All right. Is there an issue with the with my presentation, folks? Some people were complaining. I just seen it now. Is everybody? Oh, please type in. Let me know that that the right now I'm showing what's on my screen is Micron option slam page. Could I get some feedback? Huh. I'm not getting any feedback. Is anybody out there? Please type in the chat. Let me know that because I'm. Please let me know. Huh. Screen share is good. Okay. No problem. Okay. All right. All right. Well, okay. There were some complaints that the screen share was not good earlier. I didn't see them until just now. Yeah, this is Micron. Yeah, okay. Thanks, John. Thanks. All right. I think we're okay. I think we're okay. Okay. Technology issues, always a concern. Always a concern. All right, let's see. Where was I? I got lost there. I was gonna go to another more recent example, and that is here we go. All right, so I'm gonna freshen this up and take advantage of the opportunity to freshen this up. Let's look first at the 6-day pre-ER strategy here on AVGO. Okay, is this is maybe a little too small? Let me just let me zoom this into. Is 200% too much? Not if I expand this. It's not. Yeah, it is a bit. It is a bit much. Well, here's a strategy, AVGO. This is a 6-day pre-ER strategy. We'll talk about 6 days. We'll talk about the details of this here in a moment. This 150, 200% is too much. Let me take it down to 150. Let me take it down to 150. There, that's better. All right. So here we are. Earnings event 12/12/24. That was just a few days ago, right? That was I should. So anyway, when was this trade put on? 12/5/24. About a week prior. Okay, approximately six trading days prior to the event. earnings coming out on December 12th after the close of 24. So we put the trade on day one, 0%, no movement between 1 hour before the close and the close essentially. But then what happens to this trade? Opportunity to take 20%. Now, was there possibly even more profit earlier in the day? Sure, of course there was. Unless the stock closed at the very high of the day, okay, there was probably opportunity, and I don't remember if the stock closed at the high or slightly under the high. But anyway, uh, uh, one thing I'd like to mention here before I forget, and that is that this is an expensive trade. $1,270 for one contract of the long straddle, okay, at the by the call and by the put at the 170 strike. And what the thing I wanted to mention is I like to do trades in the quantity of a minimum of 3. I like 3 contracts. Now you might say, well, Marko, it's already too expensive. 3 contracts is going to be $4,000, close to $4,000. Well, I understand that, and for many of us who trade smaller accounts, $4,000 is probably too much to risk. You don't want to expose yourself to that much risk. However, remember that this trade, when it does lose, it doesn't lose very much. It's a very small loser, and I'll explain the why it doesn't lose much here when we get back into my PowerPoint presentation. But it does not lose much. You see, the worst case scenario here is it was down 6%. Now, can you be exposed to even more loss than that? Yes, but generally not. Generally not much more than that. That's really kind of the extent of it. Depends on the stock, depends on the circumstances. But this returned ultimately in one contract 331%, which is a $4,200 profit against a $1,270 risk. And it returned that. Oh, I'm sorry. Whoops. I'm wrong. Marko, wait. Let me just say no. Let me just do that. Let me say no. This is wrong, Marko. No, that's not right. Because you have to close this trade. Must close by end of day on ER day, or depending on whether the stock closes announces earnings before or after the close, after the close or before the open the next day. But anyway, must close by end of day. And let me highlight that. This is, I was misspeaking. This did not return 331% because that is if you would have held the trade through the earnings event that happened after the close on 12/12, and then the stock gapped up 25% to $224. And I think that was about 25%. But we don't do that with the 6-day strategy, the 6-day pre-ER strategy. We close the trade because we don't want to expose ourselves to IV crush. So there's the 6-day strategy. I misspoke. No. Okay. All right. So now that I've hopefully made that clear, let's go to OSBTT and let's see. This was run immediately after. This is the ZIMS trade with the 1-day result. The 1-day result. Let's freshen this up with a new ZIM. So, and then I'll take advantage of that opportunity to show you a couple things about the option slam backtesting tool. So here we go to the backtesting tab, and we go, I'm going to right click on OSBTT and open that in a new link, a new page, and we're going to go to, we're going to select the stock AVGO, and we're going to enter a trading date, which is going to be, I'm just going to punch in the numbers on my keyboard, 12/12/2024. Nope, that's the wrong trade day. No, for the Zim strategy, yes, that's the right trade day. That is the 12th. Yeah, that's the right trade day. That's the day. So they're reporting this day after the close. So we're going to choose that day. Let me just double check and make sure I got that right. Yep, 12/12. Okay, very good. And we're going to use the 155/205. We're going to use the 12/20. I'll show you the rules to this setup. Here we're going to look for now. The next thing we need to do, we put in the trade date, and then we click on this blue button, load strikes and expiry dates. Okay. We click on that, and then once we get this data, this information, you can go verify that or not. It's 99% of the time accurate, if not 99.9. And entry date 12/12. The stock closed at 180.66 at the end of the day that day. Unlike Thinkorswim's backtesting tool, and if you haven't already called Thinkorswim and complained to them about how their backtesting tool doesn't work properly, please do so. Please do so. Select the combo. We're going to buy a strangle, and we're going to do a long strangle. That means we're buying the contracts as opposed to shorting a strangle. We're going to choose the expiration cycle of 12/20, and I'll show you here in the PowerPoint portion of the presentation how we choose the expiration date as well as the strikes. And then the strikes that we chose, again, were 155 and 205. So I simply, OSBTT throws in, some suggested strikes, but it doesn't really know what strategy we're playing here. So we're playing the Zims strangle. So we'll do the 155, 205, and simply run the trade. Simply run the trade. Okay, now we've run the trade, and now we can download to Excel, and we will put that in, let's see. Well, it doesn't matter where I put it because I can pull it up. I'll just let it save, and then I can pull it up wherever it put it. It probably put it, looks like it might have put it in the wrong place, but that's okay. I can just click here and then open it from there. And now, if I see any errors here in the CSV format, I simply highlight those rows, double click in between those rows to expand those rows so that it gets rid of the errors and shows me the actual data. Now I'm going to go ahead and I'm just going to Control C, copy that data, and I'm going to just replace this old backtest and Control V, replace that data with the new data. Now, what this did is simply brought in, one more day of results for me here. And then I'm going to copy this formula down. Let's see, is that formula right? It doesn't look right. No, a dollar. It needs to be a dollar. I need to put a D. Oh, this formula is wrong. It's not dollar D. It's D shift dollar. There we go. And then we're going to copy that formula down. Boom, now we're good. Okay, so there we go. AVGO, returned on the ZIMS trade. This is the ZIMS. Let's see. ZIMS trade. Boom. Bold. Okay. So far, as of the end of the day yesterday, this returned on a $226 debit. That's the maximum amount of money you could possibly lose on this trade. Returned 1,900%, almost up to the Palantir 2,100% profit. After about almost 2 weeks, it took Palantir to get that. This got that close to 2,000% profit in easy 2 days. So there's two very recent examples of huge ZIMS trades. So that's the number 2 punch. Now let's go back to, we'll come back to Micron. We're going to come back to Micron, but let me get back now to the details of our strategy. So the 6-day pre-ER straddle. All right, let's see, is everybody's with me here? I hear you. Let's see. How do you determine strikes? Okay, I'll show you that. Is the option value, column D of the 2 contracts. Yes, the option value is the option. Yeah, very good. We are technically selling before the IV crush. In the 6-day, yeah, I'm going to get into all those details. All right, excellent questions. I'm just going to refer back to the spreadsheet here, the results from OSBTT. So option value on day 1, which is, this is the date. This is the cost of the strangle in the ZIMS, okay? And day 2, the stock moved up to 224. The value of that strangle increased to $2,000, okay? Which represents an 813% increase of profit. Here's the profit, $1,800. $2,007 less what you paid for it means you profited $1,800. That $1,800 is an 800% profit on the risk of 226. So that's how you read this, okay? This is the profit against risk. The most you can lose is $226. All right, so that, and then this is read the same way. This is, let me see if I got that formula right, $15, yes. So this is read the same way, okay? Hopefully that clears that question up. Now let's get into, this will clear up all the other questions as I go through this presentation here. All right, the 6-day pre-ER straddle. Punch number 1 of the 1-2 punch strategy. The 6-day pre-ER straddle has a few rules. Here's how you do it. Now, by the way, this is a brief, condensed version of this strategy as well as the ZIMS strategy. If you go back to optionslam.com and go visit our, let's see, if you go back to optionslam.com and go to the resources tab and go visit the OptionSlam webinar archives, you can go scroll back to many previous webinars, just like the one you're in right now, and learn more about these strategies. Now, I don't know exactly the dates when. I know that the 6-day pre-ER straddle is something that we talked about multiple times over the years. It may be a few years since we talked about it last. I don't really remember. So you'd have to go in there and search for it. You can search, I'm sure you'll be able to find it. Just search for keywords such as, pre ER or straddle or something like that. Okay. So anyway, let's see. Where was I? I was at the PowerPoint. Enter the trade around 6 trading days prior to the upcoming earnings event. Now, 6 trading days. Okay. So can I do it at 5 days? Can I do it at 7 days? You can do it at whatever amount you think, but through our back testing, we've determined that 6 trading days is the right neighborhood to put the straddle on, the pre-earnings straddle. Is it different for some stocks than other stocks? Yes, but you would have to back test many different uh, prior events and many different back tests, which we've already done, to determine which is the right number of days prior to the earnings event for the stock that you're working with. Okay, and is it going to be different than 6 days for some stocks? Yes. Could it be less? Could it be more? Yes. Is 6 a good general all-around number to use? Yes, in our opinion. Entry is simple. Buy the straddle, the at the money straddle, at the money straddle. If the stock is trading for $70, you buy the 70 call and the 70 put. That straddle, which expires immediately after the earnings event. Okay? So let me move on. Close the trade prior to the earnings event, win or lose. Do not expose yourself to IV crush. As I showed in that, believe it was the Palantir 6-day straddle. I believe it was the Palantir one. Did not do well, even though the stock moved 25% in one day. The straddle actually, I think it didn't make any money. I think it might have lost $3 or something. So this trade, well, I'll get into more details. I'm going to get into more details. I got to be careful not to go off on tangents, especially this late in the webinar, as we are almost out of time. We're going to go overtime here on this a little bit. So what are the concepts that make this trade work? Well, here's some of them, not necessarily all of them. Prior to an earnings event, many stocks have strong directional moves in anticipation of the upcoming news. The upcoming news being the earnings event. They become volatile. These stocks, many times, when it's very close to the earnings event, these stocks tend to have strong moves, either predominantly traders are, expecting good news and they're buying the stock up prior to the earnings event, or they're expecting not so good news and they're selling the stock off, anticipating not so great news. Okay. The long straddle takes advantage of volatility in either or both directions. Now, I say both directions because you can get into something that we call gamma scalping, but we certainly, I believe I did a webinar about gamma scalping. You can look into that. I'm pretty sure we did a webinar or two in the past about gamma scalping. So that's another way to manage the long straddle, the long 6-day pre-ER straddle. Another way to manage that, rather than just a pure win or lose type of management mentality, you can employ a gamma scalping mentality. Okay, so no time, but I believe there is a webinar. It is a delta neutral, so the trader is not predicting direction. The trader cares not which way the stock might go, but instead just hopes for the stock to move substantially in one direction or the other. Time is working against this strategy, though. Time is working against this strategy through the options Greek we refer to as theta. This is important. Each day that goes by, our options are losing value, the portion of their value that is derived from time, how much time there is before these options expire, is working against us. This strategy is negative theta, but vega, another options Greek, is working for us. As we approach the earnings release date, implied volatility is building each day, offsetting the theta decay. That's why this strategy has so little risk in it, as long as you close it prior to the earnings event. Okay? This is a very important concept. This strategy, the 6-day pre-ER, depends on IV building to offset the time decay that's happening. Very important to understand how this works, why this works, and why we close it prior to the earnings event, and because then otherwise all this IV build is completely crushed, plus all the prior weeks of IV build are completely gone as soon as that earnings comes out, and you will have substantial losses in this strategy if you don't close it on time. Now, can it turn out to be a winner? Yes, it can, but that is the exception to the rule. Usually, the IV crush is going to kill this strategy as a hold it through the earnings. You don't buy a straddle and hold it through the earnings. I know a lot of people do, but we have statistics right at optionslam.com that will show you that is more often than not a losing approach. Okay. All right. Moving on to the ZIMS punch number 2. The rules for the ZIMS, even simpler. Well, in a way, simpler. Initiate the trade near the close of the final trade day prior to the earnings event. Okay, so now you're out of, you just closed. The earnings event's going to be, let's say, today after the close, right? So you're going to close the 6-day straddle. You're closing that now. Once that's closed, now you can enter the ZIMS trade. Now you might have closed the 6-day straddle yesterday. It's been on for 6 days. It's been on for 6 trading days. You might have closed it yesterday. You might have closed it the very first day. You might have, it depends on when the stock moves. But bottom line is, now it's time to, once that 6-day straddle, punch 1 is closed, now you can enter punch 2, which is similar but different. Okay, these trades are similar but different. Let's talk about that. First of all, rules. Initiate the trade near the close of the final day. Determine the implied move of the front week. The implied move of the front week post ER contract. Okay? Double it. Find the implied move and double it to determine your strikes. Let me repeat. Determine the implied move of the front week post ER contract. So let's look at a live example here quick before I go on. All right, let's go back to MU, our live example. And if you'll remember, I already mentioned that the premiums are high, and this is looking at the ZIMS trade now. So what we're going to do is we're going to go to the front week, because they're reporting on the 18th. So the front week options are the options that expire immediately after the earnings event. So in this case, that would be the 20th. What's the implied move? It's the cost of the at the money straddle. So we scroll down here to the at the money, which is going to be the 109. We find the price of the 109, and we go here, and I'm going to simply uh, analyze by the straddle to find out what that straddle costs. It costs $13.50. I'm going to double that. That's going to be $27. I'm going to double that. That's going to be $27. I add $27. Let's see, where's my calculator? There it is. So I got 109 plus $27 equals 136. And jot that down. And then I'm going to go clear that, and I'm going to go 109 minus $27. And that gives me the 82. So that's how I get my strikes. Okay, so several people asked that question. That's how I get my strikes. But big important caveat here. This is not the expiration cycle I want to buy. I want to buy some time. I want to go out further in time. Now, being that the earnings is Tuesday after the close, that's only Wednesday, Thursday, Friday. That's only 3 days to the December 20s. I need more time to give this trade an opportunity to work. So I'm going to go out to the following week. Now, what if the earnings was Monday before the open or Monday after the close? Could I use the December 20s? I could, but I think I still would opt to go out an extra week. What if the earnings event is Thursday after the close instead of Tuesday after the close? Is going out an extra week enough? I might consider going out to the following Friday. Go out if the earnings event is Thursday after the close or Friday before the open. Going out to the following week is only 5 trading days. I might want to consider going out 2 weeks. So depending on when the earnings date is going to be, is going to tell you which of these you go to. So let me go back to our rules for the ZIMS trade. Double it to determine the strikes. Well, we already got our strikes at 82 and 136, but we're not going to use the December 20 contracts to do that. Instead, we're going to go to the weekly contracts that are 5 to 15 calendar days post ER. Okay. Let me just see if that. I should probably even say maybe even up to 17, maybe 17, 18 days out, rather than 15. So let me make a minor verbal correction to this. I'm going to say 5 to 18 calendar days, not trading days. Remember now, sometimes I talk about calendar days, other times I talk about trading days. The ZIMS trade, I talk about calendar days. The 6-day pre-ER straddle, I talk about trading days, okay? Does it have to be 6? No, it could be 5, it could be 7, but 6 is the right neighborhood, and it's trading days that I'm counting there. Here I'm counting calendar days, including weekends, holidays, etc. So by that 2x, the implied move strangle. So let's go back to let's demonstrate exactly what this trade would look like if we were to paper trade it today. Let's paper trade it today just to check it out and see how it happens. So we're going to go out to the December 27 contracts, and we're going to find the 82 put and buy it. Get rid of that straddle. That was just to determine the implied move. Let's get that out of there, not to cause any confusion. And let's jump up all the way up here to the 2 times the implied move, 136. And I'm going to hold my control key down. And by that, notice the huge skew in the calls versus puts. Usually puts are skewed to be higher. Here we are equidistant away from the strike of where the stock is trading, 109. I believe we went up 27 points on either side, so we're equidistant away, and we collect. It costs us $125 to buy this call, $27 out of the money, but it only cost us $25 to buy this put. So the market is heavily skewing to the upside based on options pricing, though. So that's very interesting, and it brings me back to what I talked about earlier, that this, in my opinion, is not the optimum setup for a ZIMS trade. I think the market is pricing in way too much of a premium in these calls. It's normally the put side that has an expansion of premium. In this case, it's by far the call side, and maybe the market knows more than I do, and that's usually the case. So I can't say that this is a bad trade, but it is $1.50. And we'll look at it in risk profile here. Let's get rid of this left side so we got a little more room on the screen. So there's what the and then we're going out to the December 27th. So let me adjust the 1 standard deviation so that we can see the shaded area, so that this can give us a little bit of a clue as to the probability of profit, or in this case, 1 standard deviation would be this shaded area. And for this trade, if held to expiration, would need to go way beyond 1 standard deviation. It looks like almost a 2 standard deviation to me. Let's go, yeah, it's beyond 2 standard deviations. It would need to go beyond 2 standard deviations on the put side for sure, and slightly beyond 2 standard deviations, or just almost at 2 standard deviations on the call side. So let me take this back to 1 standard, because that's what I like to have on my screen, so that I have because remember, standard deviation suggests that 68% of the time, price is going to be within 1 standard deviation. So that's why I say at the price of this strangle, to me it's not optimum, because I think it's pricey, but it's all about delta and gamma here, and anything can happen. Let's continue on with this. What are the concepts that make this trade work? Movement. We need a huge move for the ZIM strategy. Movement is also what makes the 6-day pre-ER straddle work also, right? That's we want movement in that one too, but we also have the IV build and the offsetting theta in that one as key components to what makes that strategy work. This strategy, the ZIMS trade, we're not concerned about IV crush so much. Why? Is it not a major factor? It's because the vega of those very far out of the money contracts is very low. We are betting in this Micron example, 150 bucks. And we know that we could lose the whole 150 bucks if Micron goes nowhere. Or we could lose a substantial amount of that. The contracts are so far out of the money that IV crush and to a certain extent theta decay are not our concern. It's all about delta and vega. It's all about, can this stock move to overcome the IV crush and the theta decay in a substantial enough of a way, even though those are minimized in the strategy because we're buying such cheap premium, far, far out of the money. Let me show you the Greeks in here. If we look at the what was it, the 82 and the 136. Let's look at the 136 first. The 136, the vega is 4 cents. Okay, it's 4 cents as opposed to the at the money. Let's go to the at the money. You can see the at the money 109 vega is 7 cents. So it's about double, and that's pretty typical that it's half of the vega exposure. In other words, if there's half of the vega exposure, so think of this IV crush as very large. We saw from the Palantir example of the 6-day straddle how that IV crush made that play not work very well, right? There was no profit the one if you held the straddle. But in this case, if we're buying these contracts that are way out of the money, and the IV crush is half of that, as opposed to the straddle at the money. And not only is it half of that, it's only 4 cents on $1.27 instead of double that on $7.95. Okay, double the IV crush on a much larger number. So it's really very non-consequential. It's easy for delta and gamma to overcome that IV crush on such a small premium. A small IV crush, small vega factor on a small premium. Okay, I hope I'm making that clear, as opposed to a large vega factor on a large premium. Okay, so that's why I say the vega factor is almost non-consequential, easily overpowered by a delta gamma move. We have bought some time to allow this trade to work. Why? Why do we go out in time? Because if you'll remember, if we go to Palantir and we go to the post-earnings page at optionslam.com, on the November 4th earnings, yes, the profit, the change in price of the underlying stock, okay, the change in price of the underlying stock was 23% on day one. And the ZIMS trade, I believe, was a winner on day one, a pretty substantial winner if I remember right. But look, what if it was, look in this case, look at the previous earnings event, the August earnings event. This would not have been a ZIMS winner, a 10% move. That would not, I don't have a backtest to prove it to you, but you can easily go to OptionSlam backtesting tool and run a simulated ZIMS trade. And I think you'll see in this example that it was not a winner on day one. It may have become a winner within a few days. It was definitely a winner within 2 weeks. That's why we buy some time with the ZIMS trade, to allow it time to work. Now, could things get worse over time? Of course it could, right? You can see that that Palantir has been a consistent winner with the ZIMS trade just by looking at these movements of the underlying stock 1, 3, 5, 8, and 14 days out in time post earnings. Okay. Sometimes it's an obvious winner or loser on day one. Talking about the ZIMS trade. The 6-day, you just don't know. That one is a little more, what's the word I'm looking for? Can't think of it. Other times it needs some time to develop into a winner. But be careful as you hold the trade. Theta becomes a more powerful negative Greek to your position. So sometimes you need to know where to draw the line. Again, this is why, this is another example of why I say it is, I like to do trades in minimums of 3 contracts. With the ZIMS, it's easy to do that because it's a cheap bet to start with. So it's easy to do 3 contracts in a ZIMS trade. Might not be quite as easy to do it in the 6-day pre-earning straddle because that is a much more expensive trade, And depending on your account size, you may not be willing to expose yourself to that much risk. But remember that straddle, that trade has a history of having very little risk of losing money. You don't lose a lot of money in that strategy, generally speaking. So other times this ZIMS trade needs some time to develop into a winner. Okay, so it's nice to have 3 contracts on or more because then you can lock in profits along the way or take risk off the table if it's not working for you. You know, take 1 or 2 contracts off and just let one ride to see if it can turn into a winner. Okay, so that's why I like that magic number of 3. Theta is a bigger factor as time goes on towards expiration, so be aware of that. These 2 strategies, the 6-day pre-earnings straddle and the ZIMS, are very similar. Let's go through some details about that. They are both delta neutral. We don't care which way the stock goes, up or down, just so long as it goes substantially. One is a straddle and the other is a strangle, both very similar in structure. You know, we're buying a straddle, buying a strangle, they're very similar in structure. The straddle buys a put and a call at the money. The strangle buys a put and a call out of the money. Very far out of the money, though. Very far in the ZIMS trade. They are both long premium trades, so therefore they are defined risk trades. They are both negative theta. You got theta working against you. That's why with the 6-day straddle, we want to be out of that before the, we've got the vega working for us in that straddle and theta working against us. And they are both positive vega. Okay, so there's how they're similar. Here's how they're very different. And I may not have all of the points in here that I thought of, but these are the ones I thought long enough about to write them down. The first of the 1-2 punch is the 6-day straddle avoids the earnings event, thereby avoiding IV crush. The second strategy, the ZIMS trade, cares little about IV crush because what we just talked about, it's a very small amount of IV crush because they're so far out of the money contracts, and it's IV crush on a very small premium comparatively. The first depends on IV to increase. The 6-day depends on IV to increase. The second doesn't really care much about IV. It's all about the delta. Dollars at risk. The 6-day straddle is expensive, especially compared to the ZIMS, which we're going to call it cheap, very low debit at risk. Probability of profit. The 6-day straddle, that varies the probability of profit. It's going to vary widely, but losses are small as a percentage of dollars at risk. Generally, you don't lose much if you lose at all in the 6-day straddle. Probability of profit in the ZIMS is low. The probabilities of making a profit with the ZIMS trade is low. You're going to have more losers than winners. But when you do have winners, a 2,000% winner pays for a lot of small, cheap bets. This is the 1-2 punch. And if you'll, that's apparently the end of my PowerPoint presentation, and we're way over time here. And so with that, I'll just ask you, are there any more questions that I have not addressed? Let's see. Brian says certain number of days to use. Don't know what that means, to use. Can you please show on how IAVGO's strikes of 155, 205 were picked? I think I did that, right? We did that already. I just detailed that in detail. You go to the pre-earnings implied move of the fronts and double it. The pre-earnings move of the front expiration cycle and double it. It's the same way you do them all. And it looks like I answered all these other questions. I don't see any other new. What are the ideal stocks to use? Well, I alluded to that. High EVR, yeah, that can be a consideration. That can be a consideration. So let's go to try to address that question. And let's go look at our list of stocks for upcoming earnings events. And let's look at Micron, EVR 3.4, HUT 4.9, stock that I'm not familiar with, higher EVR, SMCI, even a higher EVR. Now, can that be a winner with either of these strategies, the one punch or punch one or punch two? It can be. Can CCL be a winner? It can be with either punch one or punch two. You need to evaluate each of these stocks individually. Yes, EVR is a factor, but be careful of EVR alone, because if you just go, which one was the highest EVR? SMCI. So let's go to SMCI stock specific pages. We're here on the earnings history page, and we can see we've got some large moves. And obviously we expected to see large moves here, because why? Because it's got a high EVR. That's how a stock gets a high earnings volatility rating, is by having huge moves on earnings events. So now let's go to the weekly implied move weekly page of SMCI. Okay, all these pages here in the black bar are specific to this stock now. And let's see, right now, the implied move of SMCI is at 10.5%. What was it last quarter? 24%. What was the actual move? 27%. What was the closing move? 18%. Was this a winner? Probably not. For the ZIMS trade, probably not, because the implied move was so high and then it barely made that. It went through it for part of the day, barely made it. We got to go and investigate. Don't forget the post earnings page too. Don't forget about that. We don't have time to do that now because we're so far over time. But that's why I say be careful. It's not just high EVR, it's also how big is the implied move compared to, and you can see right now we're at a low. So this one looks like it might be ripe. Now, SMCI has been in the news lately. There's other things controlling that stock. I would guess that SMCI was probably, let's go take a look at a chart here. Let's go right back to the earnings history page. There's a chart right here. Oh shoot, it's a split involved here. It looks like a split involved here. Or was this something else? Let's just simply go to the Thinkorswim. That's a better place probably. Let's go to SMCI. SMCI. All right. Let's zoom in on the stock of most recent price activity. Now, when's the earnings event? It says that it's not confirmed at Thinkorswim. Do we have it confirmed? No, we don't have it confirmed either. I'm surprised we don't have that confirmed. That's unusual. Something's a little different. That thing's been in the news lately. It's had huge price movement. Where's my chart? Yeah, I don't know when the earnings event is. I was going to say, let's see if the 6 day, I'm guessing the 6 day pre-earnings straddle would probably be a good one on this, but I don't have I can't confirm the earnings yet. I don't have time to do that right now. I believe it must be confirmed by now. Yeah, that was a split there. See, that was a split, that big gap in our chart at Option Slam. That's because of this split. But look at there's been a very substantial move over the last 6 days. I don't know when the earnings event is, so I don't know if this one's right for that or what. It says the 19th. 6 days prior would be the 18th, and today's the 17th, which would be 2, 3, 4, 5, 6. So it closed here at $38. And it's currently at $33. That's a $5 move, and so it looks to me like the 6 day straddle would be a winner here. Looks like the 6 day straddle would have already had a couple opportunities, certainly at yesterday's open, to have that one be a lock-in profit. So anyway, back to your question. What are some key factors to look at? I think I pointed out some of them. I want to say, don't forget to look at the implied move weekly page at Option Slam to determine what is the implied move now as compared to what has it been in previous earnings cycles, and how did the stock perform as compared to its implied move. So, for example, you go here. Here's a 12% implied move, and it moved. Let's look at the closing move only. 23, doubled it. Here's a 10% implied move, almost 11. And what did it do? Almost tripled it. So a low implied move is easier to turn into a ZIM's profitable trade as opposed to a very high implied move. And it barely makes the implied move, probably not a ZIM's winner. So we provide a lot of data and information to help you analyze and determine which ones are going to be more likely to be profitable. I hope that goes to answer that question. Very good. We're way over time. I'm going to say goodbye for now. Hope to see you again in the next webinar. In the meantime, wishing you all good trading.